We're analyzing BlackRock, stock ticker BLK, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for BlackRock. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing BlackRock for your portfolio. Before we get into these valuable metrics, let's understand BlackRock's stock performance. Right now, BlackRock trades for $631.66 per share. In the last year, their stock price is up about 2%. This outperforms the S&P 500. In the last 5 years, BlackRock is compounding at 4% annually. In the last 10 years, they're compounding their stock price at 9.5% annually. Going back prior to the global financial crisis, over the last 18 years, BlackRock's stock price is compounding at about 12% annually. Currently, BlackRock pays a big 3.06% dividend yield. Their average dividend yield throughout this time frame is in addition to these compounded annual returns. BlackRock trades in the middle of its 52-week high and 52-week low. 1.5% of their shares are sold short. BlackRock is a very big company. They have a $96 billion market cap. But why should we be paying close attention to BlackRock? BlackRock is the largest asset manager in the world, with over $9 trillion in assets under management as of the end of March 2023. Product mix is fairly diverse, with 52% of the firm's managed assets in equity strategies, 29% in fixed income, 8% in multi-asset classes, 8% in money market funds, and 3% in alternatives. Passive strategies account for almost 2/3 of long assets under management, with the company's iShares ETF platform maintaining a leading market share both globally and domestically. Product distribution is weighted toward institutional clients, which roughly account for about 80% of BlackRock's assets under management. BlackRock is also geographically diverse, with clients in more than 100 countries and more than 1/3 of managed assets coming from investors domiciled outside of the United States or Canada. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. The average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns are captured here by return on capital. During this time, BlackRock has earned pretty steady returns on capital. In a given year, they're averaging about 11% returns on capital. While that's solidly above average, it's a few percentage points below the benchmark we were looking for, meaning this is an X on metric number 1 for BlackRock. Metric number 2, we're looking at a high-level view of their growth. We want to see revenue, net income, and free cash flow growth in the last 5 years. This metric is all or nothing. All 3 of these have to be up for this to be a check. We'll be including their last 12 months worth of numbers in our calculations. During this time, BlackRock has grown their revenues by 26%, their net incomes have grown by 20%, and their free cash flows have increased by 54%. It's great to see their free cash flows leading the growth charge here. Free cash flow is the lifeblood of any business. A business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later in our video to come to an estimate of BlackRock's fair intrinsic value. So stay tuned. With all 3 of these up, this is a check on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years. This takes the perspective of an individual shareholder. We learned BlackRock has grown their earnings by 20%, and at the same time, they've repurchased around 6% of their shares outstanding. These moderate share buybacks and their moderate earnings growth lead to strong earnings per share growth for the company. This is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. Similar situation to their earnings, with strong free cash flow growth and moderate share buybacks. This is big free cash flow per share growth. With our 3rd check in a row, through our first 4 metrics, we have 3 checks and only 1 X for BlackRock. But there's still one vital piece missing. You might think nailing high returns on capital and having strong growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. Metric number 5, we want BlackRock's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in their last 5 years. BlackRock currently has about $1.3 billion in net debt. At the same time, in the last 5 years, they produced just under $15 billion worth of free cash flow. BlackRock is very cash flow generative relative to the debt they're using. A huge check here on metric number 5 means this is our 4th check in a row. BlackRock would be able to pay off all of their net debt with just over 3 months worth of their free cash flows. Now it's time for our bonus. As our bonus, we're looking at BlackRock's dividend profile. Right now, BlackRock pays a big 3.09% dividend yield. This is nearly double the dividend yield from an S&P 500 ETF. However, people make mistakes all the time by blindly chasing dividends. It's important to stop and look at the underlying fundamentals to see if a business can support their dividends. They've grown their free cash flows and they've increased their dividends in lockstep. BlackRock has had a growing dividend in all 5 of these years, all while maintaining about the same modest dividend payout ratio. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, BlackRock's dividend has been supported by their free cash flows in this time frame, and it looks like that's the case currently. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this provides a slight risk premium to the yield of the 10-year treasury, and it may offer a reasonable starting point for a fair intrinsic value of BlackRock. Currently, BlackRock has just under a $99 billion total enterprise value. This takes into account both their market cap and their net debt position. It gives a perspective similar to as if BlackRock were a private business. In their last 5 years, we learned BlackRock produced about $15 billion worth of free cash flow, meaning they produced just under $3 billion of free cash flow in an average year. When we divide that by their $99 billion total enterprise value, that gives us just about a 3% average free cash flow to enterprise value yield for BlackRock. The company produced $4.4 billion of free cash flow in their last 12 months. When we divide that to get a current free cash flow to enterprise value yield, that gives about a 4.4% current yield. While these yields are split on either side of the yield of the 10-year treasury, they're both coming in below the risk premium we'd be seeking, meaning this is an X on metric number 6 for BlackRock. Just because this is the case doesn't mean you're going to toss this business out. This analysis is not financial advice. It's not a buy or sell recommendation of any security. Stick around as we come to a more concrete estimate of BlackRock's fair intrinsic value. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze BlackRock, which takes us on to using a discounted cash flow model to come to an estimate of BlackRock's fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs will be sensitive to its inputs. Starting with an average of BlackRock's current free cash flows, then projecting these into the future using historical growth assumptions, it's up to you to do your own homework to figure out if these are accurate and applicable. Assuming BlackRock grows their free cash flows at 6% annually for the next 10 years, then assuming this growth rate falls to 4% annually for the 10 years from there, if we add in the company's tangible book value, which gives us an estimate of their net worth, if we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements, from today's valuations, an estimate of BlackRock's fair intrinsic value is only around $330 per share. This is down quite significantly from the company's current stock price. Their stock price would need to fall by $300 to hit this mark. Keep in mind some important factors here. BlackRock has been a very predictable business in its past. That's not a guarantee for the future, as this could change. This 15% discount rate would be including BlackRock's 3% dividend yield. We would not be doubly counting their dividends. With their share buybacks, there are accounting reasons why their tangible book value may be understated. Keep in mind this is just an estimate. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your financial advisor. In just a moment, we'll give our rating to BlackRock, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, BlackRock's well-diversified product mix makes it fairly agnostic to shifts among asset classes and investment strategies, limiting the impact that market swings or withdrawals from individual asset classes or investment styles can have on its assets under management. Number 2, product diversity and a heavier concentration in the institutional channel have traditionally provided BlackRock with a much more stable set of assets than its peers. Number 3, BlackRock is the largest asset manager in the world, with over $9 trillion in assets under management at the end of March 2023 and clients in more than 100 countries. Then the key points supporting a potential short thesis. Number 1, while actively managed funds account for 27% of total assets under management, they generate 46% of base management fees, increasing the pressure on BlackRock to get the performance of its active equity and fixed income offerings on a more consistent footing. Number 2, despite accounting for 57% of total assets under management, direct institutional client arrangements generate just 30% of BlackRock's base management fees, given the lower fee structure attached to these larger investment mandates. Number 3, the sheer size and scale of BlackRock's operations could end up being the biggest impediment to the firm's long-term growth. There you have it for a balanced perspective of some of the qualitative aspects of BlackRock. Now it's time to give our rating. In analyzing BlackRock, stock ticker BLK, we learned the company earns above average returns on capital of about 11% annually. They've grown their revenues, net incomes, and free cash flows in the last 5 years while repurchasing around 6% of their shares outstanding. The company is easily able to support their debt load with their free cash flows. On both an average and a current basis of their free cash flow to their enterprise value yields, those were coming in below the risk premium we'd be seeking compared to the yield of the 10-year treasury. BlackRock has grown their cash flows over this time, and they've supported a growing dividend in all 5 of their last years. Their dividend seems to be sustained and healthy currently, although that has the potential to change. It's worth reiterating this analysis is not financial advice. Combining all the factors of our analysis, BlackRock looks like a strong candidate for further research. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations of BlackRock, if you were seeking a 15% rate of return, an estimate of BlackRock's fair intrinsic value is around $330 per share. The business was last at those levels in March of 2016. You'd want to be patient as you dig in and do more research. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about BlackRock with me, and have a great day.